Hello, this is Josh Belk with the Belk on Business podcast. Thank you for taking a few moments to listen in. This past week, I had the opportunity to fly down to Jacksonville and spoke at a conference for a nonprofit, and ended up talking a little bit about charitable giving strategies. And a lot of the individuals in the room, there were some of the individuals that were directly involved in the nonprofit, and it was a humanitarian, and also it had kind of a lot of kind of pastors and missionaries in the room as well. And a lot of very high-earning business owners had very successful businesses who really were passionate about both the humanitarian and the outreach aspects of the nonprofit. And many of them were kind of looking into ways that they can strategically give to be able to impact their taxes in a positive way. So there were people in the room who simply were just wanting to know, okay, how can we make a greater impact with what we have? There were those in the room that wanted to make an even greater impact and how to go about doing that, and then wondering how the tax element plays into charitable giving. A lot of times we think about when it comes to charitable giving, okay, I'm going to go ahead and I'm going to donate so many dollars this particular year, maybe to one or to multiple nonprofits, and many times business owners. I was listening actually to a podcast here a couple weeks ago, and the man being interviewed was asked kind of more or less about kind of his why. And he had run and had exited a number of businesses that had become extremely successful. And he had made the comment, but after about 2 or 3 years, I've done all the traveling that I possibly could want to do. I had bought the vehicles, I had the houses, and ended up sitting there one day and just kind of realizing, I have these resources. I have the resource, especially of money, and I have an audience, and really didn't know what to do as far as what do I do from here? Kind of understanding that, okay, I made this money, I kind of reached this goal, but it wasn't necessarily fulfilling. And really trying to find a way, okay, what can I do to make a greater impact? What can I do as far as leaving a legacy? And so he began to talk a little bit about that, and began to talk a little bit about as far as using essentially what he has been blessed with to be able to bless others and leave an impact even long after he was gone. And there are some ways that you can do this and assist in reducing tax exposure. Now, one thing we do know, and statistics tell us, and I've looked at a number of studies through the years, we know that as an individual begins to earn more money, the less percentage-wise of their income they have a tendency to give. This was actually kind of a little bit surprising to me that someone a family who's literally kind of in that poverty range, as the U.S. defined poverty, and we're going to say that, kind of maybe under $35,000, $40,000 a year, they are more likely to give between 8 and 13% of their income their adjusted gross income to charitable causes within a given year, whereas a family that earns over $100,000 a year on average gives about 3%. Okay, so generally we see kind of this, and it almost just doesn't seem to make a whole lot of sense, but someone who ends up making more money is going to give a smaller percentage of their money toward causes that they may believe in, or maybe they want to they may want to give to otherwise. So I have the opportunity within my business to work with a lot of business owners that really truly want to make an impact, and so they are kind of outside of those statistical norms. And so one thing that you want to consider as you begin making more money and you start to move into thinking not just about growing your business and how to make an impact just in the short term, but really how do I make an impact in the long term, not only during this life, but maybe even after I pass on. So kind of as being a bit of a legacy element. So let's kind of talk through this a little bit. First of all, charitable contribution. Normally when you think about charitable contributions, you're thinking about just kind of the normal giving of cash. Now, with some tax law changes here a few years ago, the amount that you can deduct as a itemized deduction on your tax return increased from 50% of your adjusted gross income to 60% of your adjusted gross income. So make the numbers simple. You make $100,000 during the course of the year. You can deduct as an itemized deduction up to $60,000, and I'm talking here specifically if it's cash donations. So it may be to your it may be to your church or your synagogue. It may be to some sort of humanitarian effort or some sort of a cause that you believe in, or a combination of them, to where you give of your resources and you're able to take a charitable deduction for it. So you write the check or put contribute the cash, wire the money in, whatever it is that you do, up to 60% of your adjusted gross income you can give in any given year. Now, if you go above and beyond that, that can be carried forward. So you can use, so say you made $100,000, you gave $80,000, that $20,000 you would go ahead and simply roll forward and use within the next year. So this is for essentially for cash donations. Now, if you're giving some sort of non-cash donation, and I'll give some specifics here. If we're talking about art, now we do have clients that like purchasing art, letting it appreciate, and then donate it. It may be some sort of a collectible item, something to that effect. So maybe something you collected as a kid, it's gained value, and you want to go ahead and donate it. Well, if you donate it to the nonprofit, and the nonprofit is not able to use it to fulfill its mission, and I don't mean it goes and sells it, meaning it gets used within the nonprofit itself, then that deduction is limited to 30% of your adjusted gross income. So let's say you have a piece of art. I have a couple pieces of art behind me as I record this podcast. And this was a gift to me a few years ago, and one is at Wrigley Field, the other one is in downtown Chicago, paintings and areas that I'm a Cubs fan, so love Wrigley Field, and we're just outside of Chicago, and I love the city of Chicago. Beautiful. Well, it once was a beautiful city. It's been unfortunately kind of faced, as so many inner cities have, a lot of destruction here over the last few years. But so these particular paintings, and say they've appreciated in value, I want to go ahead and donate it. Now, if I were to donate it to a museum, for example, okay, that museum is going to display it. I could essentially get a 100% tax deduction on the value of that art, whatever the fair market value of that art is. Now, if I were to say donate it to the church, and the church isn't going to display it, they're going to turn around and sell it. Okay, it's going to be limited to 30% of my adjusted gross income. Now, in both situations, okay, that 30% limitation, one of them, okay, I'm going to be able to take the full fair market value. The other one, if they are not using it, it's going to essentially be my basis or what I paid for that art. Okay, and so it becomes a situation where you have to evaluate whether or not you should go ahead and sell it, pay the capital gains on it, and then take the charitable deduction. So you end up having have to weigh and do the math calculations of, okay, am I going to take the 30% of the value of the art, or am I going to take 100% of the cash contributed, and weigh the charitable deduction amount and the impact on my taxes versus not selling it, of going ahead and selling it and contributing the full amount of the cash. So the 30% versus the 100%, and then weighing it as it relates to taxes. And a little bit too difficult to do on a podcast to try to draw that visual, especially since most of the time it's just listened to in an audio format. But just to be aware that if you contribute some sort of art or collectible, something that is kind of a personal property type donation, it is going to be limited to 30% of your adjusted gross income, and then unless the entity is using it for its nonprofit purpose, then it is going to be limited to 30% of your adjusted gross income. So we're talking about donation of non-cash items, stocks, bonds, other appreciated assets. You can avoid capital gains by contributing it, but once again realize that it is limited to 30% of your adjusted gross income. Now, for individuals that are over 70 and a half years old, they can do what's called a qualified charitable distribution. So they can essentially distribute money directly from their retirement plan to a nonprofit. Now, they can't take the funds and donate it. It's going to be donated directly from the nonprofit, directly from the retirement plan to the nonprofit. So from an IRA or a 401k or wherever, a pension, whatever the case may be, and it gets contributed directly to the nonprofit, then that individual can avoid taxation on that money. So immediately, of course, they're not going to get a charitable deduction for it, but they are not going to have to pay income tax on that money. It's a direct charitable contribution, and that's called a qualified charitable distribution. And if you're over 70 and a half, or have a family member that's over 70 and a half, maybe something that can be helpful. Other ways that an individual can go through and donate and maybe help to impact their taxes would be to either to pre-fund or essentially bunch their contributions. So say, for example, they're looking at a situation to where they made a good amount of money we're in 2023. So they made a good amount of money in 2023. They see we're going into a recession. They don't think they're going to do as well in 2024. or they want to see their I'll get to that here in a moment, but they're maybe not going to have as good of a year in 2024. They may say, okay, I'm going to go ahead and just contribute all my money this year. Normally I would give, say, $10,000 this year and $10,000 next year. But you know what? I'm going to go ahead and pre-fund. I'm going to go ahead and just donate fully the $20,000 this year. That way I can take the $20,000 as an itemized deduction on my tax return this year, because I'm going to give more so I can itemize. And so once again, it kind of gets into that situation to where you're going to want to evaluate your current status. So are you in a situation to where normally you give $10,000 a year, but you're not able to itemize at that level because $10,000 with the SALT deduction, state and local income tax deduction, $10,000 with charitable contributions, and maybe you only have a couple $1,000s in mortgage interest. The standard deduction is around $27,000. You can't itemize. But if I give $20,000, that's going to put me over, and I'm going to be able to itemize, and then I'm not going to give anything the following year. So I'm still going to give the full $20,000, but I'm going to give it all in this year instead of 10 and 10. So another consideration that you may want to make. Another way about kind of going and donating in the current year to be used in future years would be what's called a donor-advised funds. So you can contribute to a donor-advised fund. So say let's go back to the example of the $20,000. You can put the $20,000 into the donor-advised fund and simply say, okay, I'm not going to donate it. It's not going to. The remaining 10 isn't going to go to the nonprofit until next year. So in the first example, you've given the $20,000 directly. The nonprofit can go ahead and spend it that year. If you contribute the $20,000 to a donor-advised fund, I'm going to get the $20,000 deduction this year, and then I'm going to direct it to say $10,000 this year and then $10,000 next year. If you want to hold off on essentially giving the $20,000 to the nonprofit in the following year. So that's another way of going about contributing money, pre-funding essentially for charitable contributions, is utilizing a donor-advised fund. We have a number of clients that have set up private foundations or even public charities, so 501c3s. So you may go about setting up your own foundation or setting up a nonprofit that you may direct or you may run, or maybe have a family member run, or a business associate, whatever the case may be. We have a number of clients that they have a passion in a particular area. And it may be something education, it may be something religious, it may be something purely humanitarian. Whatever the case may be, they have a passion for it and they want to make an impact, and they want to be able to essentially control that impact. They would go ahead and set up their own nonprofit. They're definitely more expensive to set up, and there's more requirements on the setup phase than just setting up a corporation or an LLC. So it is a little bit more work. There's an additional application that has to go into the IRS. It needs to be done. You're probably, in all likelihood, going to need a professional to help you through the process. But it is a way that you can go about just setting up your own, contributing to it, and then provided that nonprofit is set up correctly, you're able to get your determination letter, then to go ahead and distribute the funds for the particular cause that you're passionate about through either the foundation or through the nonprofit. Lastly, let's talk a little bit about legacy giving. So that individual who has made a lot of money and they want to consider utilizing it for charitable purposes, they can utilize what's called a charitable remainder trust. So a legacy giving or planned giving can be done through a charitable remainder trust. It is a tax-exempt, irrevocable trust. So once again here, it is irrevocable. Once you set it up and once you fund it, it is, at that point, irrevocable. So essentially what you're going to do is you're going to put assets into this trust. And so you're going to donate assets to the charity and then essentially allow for it to draw income for a lifetime. Assets can include, but not limited to, cash, stocks, mutual funds, real estate, and private business interests. Okay, so this is a way that you can go about putting money into the trust to benefit both the charity and also the other beneficiaries of that particular trust. So the trust needs to properly report income and distribution to beneficiaries. So maybe you have this large amount of assets, you want to put it into the trust. You may have your children as beneficiaries of the trust, other family members, other individuals that are beneficiaries of the trust, as well as a nonprofit. So the distribution can either be a fixed annuity amount, so that's called a charitable remainder annuity trust, or it can pay a fixed percentage of the assets every year. So the IRS does require the annual payout to be at least 5%, but no more than 50% of the trust assets in any given year. Once the trust is established, the grantor selects income beneficiaries and a charitable beneficiary. Okay, so the individuals are going to receive income from that particular trust and then a charitable beneficiary. So the grantor receives a partial tax deduction for the funding of the trust. So if it goes through and it funds the trust, it is going to get a partial charitable deduction for a portion of the assets contributed for the trust. For the charitable remainder annuity trust, the value of the contributed property is reduced by the present value of the unit trust interest for a term of years or for the life of the income of the beneficiary. So there is a complex sort of calculation that goes into play here. So if this is something that you're interested in, you're going to want to look at. So for the charitable remainder annuity trust, the deduction is the value of the donated property less the present value of the annuity. So for those of you who took high school and college finance or calculus courses, I'm sure it brings back some memories there. And then 30% and the 60% rules that we talked about earlier do apply. And then after the defined timeline or the death of the grantor, the remaining assets are distributed to the charities and the beneficiaries as you've previously had directed. So it is a way that you can go through, put assets into a trust that is, you have your income beneficiaries and also charitable beneficiaries as well of the particular trust, and it can be structured in a number of different ways. So just kind of a really high-level primer of charitable giving, different areas you may want to consider giving, and hopefully, if you're a business owner or have the ability to make an impact because of the income that you do generate. Something to think about, maybe different ways to give, different ways to impact your taxes in a positive way and to reduce your exposures. You can make a greater impact with what you have been blessed with. This is Josh Belk with the Belk on Business podcast. Thank you for taking a few moments to listen in today. Have a wonderful day.